Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, good morning and welcome to the Smart Investing Show. I'm Brent Wilsey, just about 8:01 on Saturday morning. Great to have you here this Saturday morning and every Saturday morning talking about your money, the economy, investing, and all these important things to help you grow your net worth. And with me to help on that is Chase. Good morning, Chase.
Hey, good morning.
We got a lot to talk about today, and let's just jump right in because I know you're very excited. A lot of people are talking about the Super Bowl. Well, also, we look at it a little bit different than the players and stuff like that. Well, although you do. I mean, you played football through college and everything. But we look at the number side here. And, yes, the big game is now just, well, tomorrow.
Yeah, it's coming quick.
As always, we like to take a look at some numbers before enjoying the games. One that stands out to me is the cheapest ticket. Well, $3,408 almost at a share per ticket. If you looked last week to secure a spot, the cheapest seat was $5,300. And this is the one I love. I thought about it, like, no, I don't have that much money. If you want to enjoy a suite with some friends, it would cost more than $906,000. There is definitely a lot of money still left in the economy with people affording these type of prices.
And I think I saw somewhere, too, I couldn't find it yesterday when I was looking at the numbers, but I thought I heard that ticket prices were up, like, they almost doubled. Like, yeah. I mean, they've just skyrocketed. It's kind of catching that inflation train along with everybody else. But, I mean, gosh, you look at this, and, I mean, there is a lot of money in the economy because it's not just the ticket. That's just for one ticket. You got to pay. You're not going by yourself. You know, if
that's
you go
right.
with a spouse or a kid.
Maybe somebody did. Maybe somebody did.
But then you have the festivities around the weekend. You have the travel. I mean, this weekend's costing you probably, I don't know, $50,000 somewhere around there. It's insane. But it's not just the ticket prices that we took a look at. There's another interesting aspect that we were looking at. And unfortunately for the players, the game takes place in California, and while they're probably enjoying the sunshine compared to some areas around the country right now, the thing that we look at is the $150,000 bonus for players on the winning team. Well, it's going to be taxed at a higher rate than last year's Super Bowl champs. Reason for that, California has a top marginal tax bracket of 13.3% versus no income tax in the state of Florida, and the way that players pay taxes, kind of wherever you play right that week, you have to file a tax return. So it's not just the bonus, but also their salaries this week. Kind of sucks that you're going to get hit hard with the California taxes. So enjoy that, players. And then other thing, too, that we look at is always interests me. The cost for a 30-second spot for an advertisement hit a new record of $7 million. And gosh, I mean, those ads need to be really captivating to recoup that investment.
Yeah, and it's kind of funny because I still remember, and I think, I don't want to say like 10 years ago, I believe like, wow, maybe it's a bit longer, $1 million for a 30-second spot. Now that's 700% higher. And we probably should look that up, but I just thought about it now because I do remember it was a big deal to hit $1 million. But that's going to be quite the game. And I guess you're going for, who are you going for?
Bengals. I love Joe Burrow. That guy's awesome.
Oh, wow. Well, okay, that's what we play, Joe Burrow.
Yeah.
I was watching a thing yesterday on Joe Namath, and he was talking to Barney on Fox Business, and he said some quarterback name, and Barney just like, who?
Yeah. Well, it's funny. You look at Joe Burrow, and he doesn't look like much. Yeah. Like if you saw him on the streets, you would think NFL player.
Right.
He's got like a baby face, and
really?
But he's a winner. He's fun to watch. He's got swagger, is what I would say about him. So I'm hard to not root for the Bengals. They're the underdogs, so I'm going with the Bengals.
All right. Well, I'll go with you there because I don't know. Although I know a lot of people, LA Rams, they like the Rams. So I don't know. We'll see.
It's hard because my uncle's a huge Rams fan, so I haven't told him I'm going for the Bengals, but he probably wouldn't be happy.
And I think I did see, gosh, I can't remember the number. The amount of money being bet on the Super Bowl, I believe it's the biggest ever. Is it like $7 billion bet on this game? Is that the number?
Yeah, I know it's an outrageous amount. Yeah. I mean, it's crazy. And again, comes back to the same topic we discussed. A lot of money in the economy.
Yep. So people are willing to bet. So, but let's talk about things that aren't so good. The trade deficit, I was disappointed to see the trade deficit come in at a record-setting level for 2021. And this is not where you want records. The trade deficit has now reached $859 billion on a yearly basis. That's an increase of 27% over the previous year. Also concerning to me is roughly 40% of the deficit is with China at $355 billion, an increase of 14.5% over 2021.
And the thing we got to look at here is a large trade deficit. Well, it's dangerous because we're giving away our dollars to the world and China in exchange for goods. I mean, eventually the world and China could own us. And we've said this many times over the years that we need to reverse this course before it's too late. And I was thinking a great example of why this trade deficit is so impactful as you look longer term. Well, we've discussed a huge problem lately with semiconductors.
Yeah.
And we've talked about how we used to control the manufacturing here, and we started outsourcing it to all these different countries. Well, now the supply chain got all messed up. Now you're seeing huge shortages in semiconductors. If you keep outsourcing everything that we're doing and keep trading all these different goods across the borders, well, we're going to have major problems here because, again, we talk about issues with Russia and perhaps China. They stop trading with us. I mean, we could have huge issues if they cut off supplies for our goods. That's not going to be good for inflation either, I'll tell you what.
And actually, Russia and China had a record trade themselves. Relationship. I think it was like $147 billion, if my mind serves me correctly. They never used to be that buddy-buddy. And it kind of worries me that they're getting closer and closer because it's not good, because the United States could be kind of left out in the cold. Like, well, we don't need the U.S. anymore for that. We'll just get to China. We'll get it from Russia. And they've got enough energy over there now. Russia's giving China, not giving, but selling them energy. So we're in a difficult situation with them, and we got to do something to turn around. The thing and some people say, well, they just don't really look at the trade deficit. Who cares? I compare it to, it's like high blood pressure. You don't feel it, you don't see it, but one day it causes a heart attack. And it's the same thing with this. You don't feel it, like, yeah, we'll get our products and so forth. One day it's going to cause a heart attack to all of a sudden, like, wait a minute, they've got all this money and we've given it all to them. We've got to stop this. It gets worse every year.
Yeah, and I don't want to spend too much time on this side of things, but I got to say it. I mean, what happened to our trade deal? That's obviously not going the way it was anticipated. And I'm going to say it. Biden said he was going to be tough on China. It does not appear that we're being tough on China. It seems like, again, we're giving them everything, and they're giving us nothing back.
Yeah, I mean, where's the enforcement of that trade deal? Because China's not kept up their end at all, which would help reduce, the deficit there. But there's no teeth there, and that's what you have to do. And we won't get too political, but it's just, we need to enforce those trade deals because we're not on a good path. And I know we try to be like, critical race and woke and clean energy, but that's not going to help with the world, because the world is getting more powerful and more valuable. We'll call it China and Russia. They don't care that you have clean energy. They don't care that you're fair to everybody. No, they want to take you over and we're like a gold mine here. We got a lot of natural resources and again, it's not going to happen in 6 months or 12 months, but we keep on this path. Eventually, the United States will be very weak as they get stronger and stronger.
Yeah, and I again just want to drive home that point back to the economy is we need to have cleaner supply chains. I mean, we've seen how disastrous that the shipping has been with the ships being stuck off the ports and not being able to get your goods. And I mean, you look at the auto industry. I mean, you can't get chips to build the cars. You can't put the cars on the lots. Now what's happening in the used and new car prices, they're just going through the roof. Yeah. That is just one problematic area that we've kind of seen that really stands out. If you start to apply this to different sectors as well, if we start, talking about like steel, energy, whatever it may be, if we start just taking resources from other places around the world and we start to rely on that supply chain too much, that's where you see the problems that we've seen in the auto industry.
Yeah. So it's something, and again, I don't want to have like the smokestacks and terrible air and so forth. I don't want people to think that's all about, but you've got to sometimes do things slowly, to get the clean air slowly. to get these things slowly. So phone numbers, by the way, you want to call in for that unbiased, no strings attached, fundamental opinion about what you want to talk about. 833-288-0973. That's 833-288-0973. Jason, numbers are in on inflation, and it's no surprise that inflation rose by 7.5% over the past year. It was the largest annual increase since February 1982. What effects does this have, or will this have, besides the obvious? Well, interest rates are rising. The 10-year Treasury this past week, I think it was Thursday, did cross the 2% level. That's the first time since August 2019.
And the other thing we also saw was the 30-year fixed mortgage rate came in at 3.69%. And I do believe this next week we will see that closer to 3.8%. The rising rates have definitely led to a slowdown in mortgage applications, as last week applications to purchase a home were down 12% compared to last year, and applications to refinance a home down 52% compared to last year. I mean, this could be the reversal in the housing market that we've been kind of talking about.
And this is going to affect other things as well. I mean, it's going to affect like Maytag, because a lot of times you're getting a new home, you want a new washer and dryer. It's going to affect other ones. Carpeting companies could affect carpeting companies because, well, maybe they won't put carpeting in the new home, change that. So there's a lot of things that this does actually affect. And this is what people don't realize. And I with inflation rising, it's coming from too much money in the economy. And I'm going to have to blame our current administration. They thought it was a good thing. And they even said, oh, more money does not cause inflation. Like, I don't know if they went to basic economic school or not, because obviously it does, because you have more money chasing fewer goods or not enough goods. It's going to raise the price. Whoever can afford my price, you get it. So it is a problem.
Yeah, and I did want to kind of look at some of the areas that did really spike. I mean, I kind of pulled some numbers on, energy. That was a huge contributor. That was up 0.9% in the month and 27% compared to last year. I mean, we all see the gasoline prices. And gosh, gotta say this, Harrison, our financial planner, his sister's in town right now, and we're driving past the gas station. She's like, whoa, what is that? That gas price over there.
And she's from Arizona.
Arizona.
Right?
Yeah. It's like, oh, yeah, we're lucky here in California. But it is still higher across the entire industry, the nation. The other thing I talked about as well is the vehicle cost. I mean, this is just, it's insane. I mean, if you look at the vehicle costs in particular, they were flat for new models and up 1.5% used cars. I just can't believe that used cars continue to climb. And looking at the two categories year over year, well, new models, they were up 12.2%, and used cars, 40.5%.
Crazy.
In the last 12 months. It's insane. Yep. I mean, it's a runaway problem, and this is the one that I think is going to continue to be an issue, and that's shelter costs. They make up about 1/3 of the total CPI. They increased 0.3% on the month. It was the smallest gain since August 2021, but the category is up 4.4% over the past year and could keep inflation readings elevated in the future because it's such a large portion. And we've talked about this in the past, but I want to reemphasize it, is it's not based off home prices. It's based off kind of, I think they call it rent equivalency, essentially. So it's what you could rent your house out for. Well, we see rising rents all over the country because people that are buying these houses, well, you got to increase rents to recoup your investment.
Yep.
I think that's going to keep inflation elevated for, I think, the next few years.
Right. I want to give our listeners a tip as well, because if you are looking to buy a car, you might want to buy a new car. Ford and General Motors come out and said, our dealers will not be charging above the MSRP. If they do, there's going to be consequences. The consequences, they will cut their inventory going forward. There's some other things they didn't bring up. But if you do want to buy a new car, you might have to wait for it because they're not there. But Ford and General Motors products, they have to be selling those at the MSRP, the dealership. And if they're not, I would go down the street to somebody else that is, and I'd also would report them to the corporate office at GM and Ford.
Yeah, no, that's a good point. And just kind of back to the inflation item, I mean, that's kind of what I think is really going to continue to move the market. I mean, you've seen, the market is doing okay, and then the inflation report came out on Thursday, and I mean, the last 2 days for the S&P, the NASDAQ, specifically the tech companies, again, you see them, they're just getting crushed.
Right.
And if you continue to see the 10-year note climb, and I'm still thinking we'll see somewhere around My prediction earlier in the year was 2 to 2.25 by year end. I mean, we're already at 2%.
Yeah,
So
yeah.
I still think we'll end somewhere around 2.25 for the full year. I mean, that's not going to be good for the big tech. So be cautious. I think you're going to see inflation remain high next month, which could put some big pressure on the Fed at their next meeting. They're talking now perhaps a 0.5 percentage point increase rather than a quarter.
Yeah, and that could raise things. We could say closer by the end of the year, a 3% treasury. You know, I was watching a thing yesterday on Warren Buffett. He was talking back about 2018. They're going, yeah, you know, the 10-year treasury is at 4%. You know, it's not bad. You know, I'm thinking, whoa, so we could go back to 4%. And that seems bad when you go from 2 to 4, or actually I think the lows of 1.3 to 4.
Yeah.
But it's just, I mean, the economy can still grow at that 3 and 4% range, but it's going to have to be a slow, gradual thing. And if we hit 3% by the end of the year, if it's slow, I think it'll be fine. But you will see a slowdown in housing. You'll see a slowdown in things. But we need that to pull back on inflation. That's it. There's going to be a little bit of pain there.
Yeah.
But that's okay. Phone number is 833-288-0973. That's 833-288-0973. I look over like all phone lines are open. So I did want to kind of talk a little bit more on the oil since we have it there. And this is to President Biden, and you need to open the oil and the gas lines immediately. On Friday, February 4th, China and Russia announced, this is what I was talking about, a new oil and gas deal valued at roughly $118 billion. It should also be known that the trade between the two countries hit a record $147 billion.
Yeah, and the only way to really stop Russia is to flood the world market with oil and gas. I mean, we have plenty of it here. It would drive down the price and hurt Russia's most valuable product, oil and gas. By the way, this would also help our economy by reducing inflation and driving down our energy costs. And again, energy costs are such an instrumental part of so many businesses. You talk about transportation, you talk about airlines, you talk about trucking, you talk about all these different sectors that have these higher energy costs that get passed on to consumers. So that would be a huge help to our economy and also hurt Russia. I do fear if we don't do this soon, it will be Russia and China against the U.S., and that would put us in a very difficult situation. I guess Biden is talking to Putin this morning, so we'll see how that goes.
Well, I think Putin's rather tough. I hate to say this. I don't think Biden is. I think Biden's a little passive on certain things, and it's Russia's tough. China's tough. I mean, we need a tough person. Biden, you got to step it up a little bit and be a little tougher there. And it's no secret that gas prices at the pump are high because of a shortage of oil, and we all know that was caused by the shortage of OPEC Plus is coming up short by 790,000 barrels per day on production goals. Yeah,
and it's, again, the increased regulatory environment, not encouraging drilling and transportation of the energy. I mean, we have it here. We need to open it back up, and we need to become energy independent once again. And as I said, the inflation, there's a couple different ways we could help with the inflation other than rising interest rates.
Yeah, and it's something that's just very difficult because we know it's here. And the oil companies, the U.S. oil companies, have kind of pulled back on their development going forward because they don't want to put all the money into it. So we got to turn the energy situation around here in the country.
Well, and it's important, too. People blame the oil company. Well, the oil companies still have to be profitable, so they're saying, well, we can't invest as much because we don't have as much capital when oil prices were low because it's not as profitable. And, now it's kind of this self-inflicting wound. And the oil companies now, well, they're doing great because oil prices are high. So, I mean, I'm very happy we have an energy company in the portfolio. We've been talking about it for years about having a good energy company, and it's paying off now. I hope people listened and put good energy in their portfolios.
Yep. Well, again, phone lines are open, 833-288-0973. Let's go out to the callers here. Let's go out to Doug in Terrasana. Doug, you're on the Smart Invest Show. Brent Chase, how can we help you?
Hey, Brent. Hey, Brent Chase. I'd like you to take a look at a company called Prologis, PLD.
Okay. And do you hold that or looking to buy that?
No, I think it was last week, there was a short article in the Wall Street Journal. They had just announced their quarterly results with a very positive, and the CEO painted a pretty positive picture going forward.
Okay, we'll go. So let's take a look at Prologis. symbol is PLD. We see it in the real estate investment trust area. I was surprised on that. I thought it was a regular company, but yeah, it's a REIT. We do see that they have short, not very much, 1.6%, but 97% is owned by institutions. We do see a PE ratio of 37.2 versus 21 for the industry, so that's expensive. Sales are expensive, 23.5 versus 16.2. Price to book value, 3.3. That is better than the industry at 8.5. Then price to cash flow, 37.3. Once again, more expensive than the industry average. They do not have a PEG ratio. We do see their earnings per share growth over 1 year was 96% for PLD versus 43 for the industry. Sales growth up 7.2, not quite as good as the industry at 10. You do get a dividend yield of 1.7%. They use 63% of their earnings to pay that out. Not quite as good as the industry at 2.4. I'm surprised with a low dividend, this being a REIT. Usually get a little bit higher than that, to at least around a 3 to 4. Look at the balance sheet. You got a current ratio of 1 versus 1.5. Debt to equity looks good, 0.5 versus 0.7. And then we've got a net profit margin. Now, these are strange, 61.8% versus 75.7%. I'd really want to look at that income statement to really understand how they're getting such a high net profit margin. Return on equity, not that good, 8.8 versus 10.9. Jace, what do you got?
Yeah, I'm wondering on the net margin if they sold some properties. That's generally how it's a little more cyclical in the REIT. But I just got to reemphasize, I was shocked when I saw that debt level. That's really low for a REIT. That's quite intriguing. But current price here for PLD, it's $146.31. 52-week high, $169.93. Wow, actually hit it on the last day of 2021. On 12/31 is when they hit their high.
Oh, wow.
52-week low, though, $94.14. Year-to-date, I see they're down 13.1%. Moving forward, a little disappointed here, actually, very disappointed, because I see 2023, their funds from operations, again, that's how we value the REITs rather than earnings, because of kind of cash flow, the depreciation on real estate and so forth. See, it's $5.48. Would give us a target sell price at $90.97. And this REIT, they've been a huge benefactor of the e-commerce space. They kind of help with the warehouses, it looks like. The e-commerce type businesses is who their clients are, which has been a big boom for them. But it looks like that growth is slowing, as FFO from 2022 to 2023 is estimated to just grow around 9.8%. That's not huge growth any longer. I worry that that could impact it. I think it's in a great space. I think the business is fine. It's just too pricey.
And Doug, I'd be really curious more about what this does. You said the warehousing space, you think, Chase? Is that what you
because it says they have... Oh, go ahead, Doug.
Apparently they're a big warehousing and logistics operation. Mm-hmm. And they've been pouring a lot of money into the automation that the Amazons and the Walmarts of the world are demanding of their providers. And I guess they're classified as a REIT, but sort of in the gray area between being a REIT and actually being a brick and mortar operation. What caught my eye when I read the article was their profit margin seemed really high.
Yeah, and that's why Chase said maybe they sold something off or something there, and that's why you got to dig through the income statement to see what is there. But I think it's an exciting company, but that's why I think the stock is probably a little bit too high. Actually, maybe a lot of bit too high, and they just don't seem to have the earnings going forward.
I mean, like I said, I think it's a great real estate play if it was priced
better
properly, because I mean they have a diverse base. It's not like they're just with Amazon, just with Walmart. It says they have 5,500 customers, and again, they're primarily in two major categories: business, and retail/online fulfillment. So again, they're holding those warehousing spaces, which we see all over the place now. But talking about those big players, I do wonder how much Amazon and Walmart are of their business, because Amazon, we know, has a boatload of money. They could all say, I don't feel like, paying rent anymore. We're just going to go buy a building or buy a warehousing space.
Right, yeah.
So that's something that could hurt their business, just something I would be intrigued on. But to be quite frank, not worth the research, because it is so pricey.
Yeah. All right, Doug?
Okay. All right, thanks.
All right, thanks for calling. Have a good one. Bye-bye. All right, that is open to the phone line, 833-288-0973. Let's go up to Temecula and speak with John. John, you're in the Smart Invest Show, Brent Chase. How can we help you?
Hey, good morning, Brent and Chase. Thanks for taking the call.
Oh, thanks for being there.
Sure. Hey, I'm looking at trying to get another insurance company in the portfolio, and I'm looking to see if I'm missing something on Mercury Insurance. I know they're more California-based and a little bit more auto-based, but pretty well diversified. And I'm looking at the numbers, and everything looks pretty good. And they're hovering at that 52-week low, and I put a small position in, but looking to buy some more.
And John, we'll look at the numbers here for you, but you mentioned that they're more California-based, and it immediately brought me back to, I think 20 years ago when I made a mistake and I bought Office Depot. I thought, well, this is a great company and how good it is and so forth. And then I found out that they were really concentrated, I think it was in California and Florida, which when the real estate market turned and went down, they got hammered because they were not diversified across the country. So just put that in the back of your mind. We do like companies that are diversified across the country because there are different economies throughout the country. So if it's mostly in California, we want to be careful here.
Yeah, and the other thing, speaking about California in particular, is I'm going to say they don't have the kindest regulations. And we do have an auto insurer in our portfolio as well, and they were talking about price hikes all across the country, and they're able to raise prices. They didn't single out particular markets that they were kind of having issues with the regulators on implementing those price hikes, but I would be curious to see how Mercury's relationship is with the state of California and if they're going to be able to implement high price hikes. Because as we talked about, the used car prices, well, that's having a huge impact on these auto insurers. We know the cost of labor, the cost of parts. That's why they're needing to raise their prices, is to offset those prices. So if Mercury can't offset that, that could be a huge problem for them.
And we think insurance companies are great long-term investments. But let's take a look at Mercury General. Their symbol is MCY. Only about 4% float is there. Only 42% institutional ownership, which is pretty low. But a great start. This is what we like about insurance companies. They generally trade at good levels. PE ratio for Mercury is 7.6, below the industry at 10.6. Price of sales, 0.7 versus 0.8. Price to book value, 1.4 for Mercury. That is below the industry at 2.4. And price to cash flow, also looking good, 4.9 versus 6.6. Now we have a nice PEG ratio, which is your price earnings divided by growth going forward. 0.5 for Mercury versus 2.1 for the industry. Earnings over the 1 year changed about 2.7% for Mercury. The industry up 131%. That is something you want to look into. Why did the earnings only go up 2.7%? Did they have some write-offs or a big year the previous year? You want to understand that because it's so far below the industry. On sales, they were up 6.1% for Mercury, which beat the industry at 2.9. They do have a 5-year earnings per share growth estimate for Mercury of 37.9. That's very good, especially compared to the industry at 8.5. Nice dividend here, 4.8%. They only use 36% of their earnings to pay that out. So I like seeing that. Insurance companies do have a little bit different balance sheet, so there's no current ratio. Debt to equity looks good, 0.2 versus 0.3. We do see the net profit margin is 9.6 versus 8.6, and return on equity is 17.9 versus 13.9. Chase?
Yeah, so current price here for Mercury, well, it's $52.60. As you said there, John, off its 52-week high is $67.88, and the low, $50.37. Year to date, it's about flat so far. It's a little bit on the smaller side for, I'm going to say, the brand recognition. I know Mercury, but I think it's because we are here in California. Market cap's around $2.9 billion. Going forward, though, disappointed by this number. It looks like December 2022, the estimated earnings per share is just $3.40. That would give us a target sell price around $56.44. Now, I will point out, there's just one analyst that follows it, and I'm not that surprised seeing that because the institutional ownership is so low.
Right.
I don't know if this company needs to do more road shows, kind of get more involved with the analyst community, but there's not a whole lot of information out there from analysts. So you're kind of on your own here, John, which always gives me a little bit of cause for concern.
Yeah, and it's kind of a small company at $2.9 billion. And John, the thing I'd be looking at as well is, like, are they really concentrated in California? If they are, I would probably, because I liked what I saw. Didn't like what you came with the earnings coming forward, Chase. But it just, if it's too concentrated in California, California is a highly regulated state. Now, maybe you know something about November. Maybe in November we're going to get a different governor. I don't know, but that would change things. But right now, I'd be concerned.
And the other thing I would look at here too, John, is where is their concentration of business? Are they purely auto?
Yeah.
That does cause some concern for me as well. As I said, we do have an auto insurer, but they also have homeowners. They also insure, refrigerators, tablets, kind of technology products. So they have a diverse set of products that they're insuring, where I do worry a little bit more about auto. I mean, we're not going to go to autonomous driving here next week, but we've talked over the longer term. Who's going to be responsible for crashes if we have autonomous vehicles? Is it going to be the car makers? I know GM, for example, has also talked about doing their own auto insurance on their vehicles.
Yeah.
So there could be more competition coming into the auto space. I would just want to make sure this company has kind of a backdrop and it's not just a pure auto insurance play.
Yeah. And I got really excited, John, when I saw that 4.8% dividend yield, but don't get excited by that. Look at, again, the things we talked about for you. All ready?
Yeah, you bet. And they're about 70% California based, and but their dividend looks pretty solid over the years, and they are heavy auto, but they've got other businesses as well. So a little bit of a crapshoot. But thanks, guys. I appreciate your perspective.
All right, John. Thanks for the call. You have a good one. Bye-bye. All right, that does open the phone line, 833-288-0973. That's 833-288-0973. Let's go up to San Marcos and speak with Phil. Phil, you're on the Smart Invest Show, Brent Chase. How can we help you?
Hey, good morning, guys.
Morning.
I wanted your guys' comments on a fertilizer company called Mosaic, MOS. I bought in very small percentage, probably 0.5% of my portfolio, and was wanting to get the numbers from you guys to see if I should add any more. But before you do that, can I just get your comments on kind of the same topic? Do you guys believe in the overreactions sometimes that you see from analysts? There's one thing that we're both in together, massive insurance conglomerate. They just released earnings in which they made $1.1 billion in the quarter.
Right.
And one analyst downgraded them from buy to hold, and their stock dropped massively. And I'm saying that's ridiculous. So I thought that was an opportunity to buy up. It corrected itself, and 3 to 5 days later, and I sold out. Do you guys ever believe in that, or what's your opinion or thoughts on that?
Well, I mean, because we're buying businesses and we don't care about one analyst, like, he downgraded and the stock went down and so forth. We would not trade that stock, but it could be that it's like, this created a great buying opportunity for it. But I don't pay attention to one analyst. That's why we look at the mean of all the analysts, because some are going to be way high, some are going to not like it, they'll be low. It's also why we like at least like 5 analysts, so you get a nice spread over there.
And we'll listen to what they're saying. And one that always cracks me up is like, we're downgrading it from buy to hold because of short-term pressures. Long-term, we still think it's really great, but short-term, we think there's some pressures. I kind of chuckle at that one. It's like, well, that's not what we do. I don't care about the short-term. We're buying this business longer-term. So great, you think it's a buy long-term, but short-term trying to trade it. Good luck.
Yeah, and it's just one of those things that we're buying the business for 3 to 5 years, and we don't really care that, we bought it. We when people come in, we tell them, well, we'll buy here, and it goes down, it goes up. I mean, that's going to happen when you invest. You can't look at the short term, and especially just because one analyst. And the other one I like too, like, we downgraded it. The stock might trade 100. We downgraded it from $150 a share to 140. Well, it's still worth more than it's trading now. So what difference does your downgrade?
And the stock goes down. It's like,
right.
It's still way above.
So we don't pay too much attention to the analysts as an individual thing, because there could be a thing there. So does that help you out there, Phil?
It does. And Chase, do you know what company I'm talking about?
Yeah, I think I do.
Okay.
I don't want to give it away to the listeners, though.
Yeah. No, I don't either, and that's why I'm kind of careful. But I like doing those things because I think a lot of the times, short term, and these are the things we're in together. I just love taking advantage of those overreactions.
Yeah. Many times.
But I am curious about Mosaic, MOS.
Yeah, and this is an industry that I kind of look at, and I wish, and again, you can't do everything. We always kind of make fun about the motley fool, like, you would have 600%. Well, yeah, because they can buy everything because they're not having the cash to buy. We got to be, particular. But I'm glad you called about this one, because I think we missed this one. And the fertilizer, I keep seeing it because we know that, inflation's coming up. Food prices are coming up, and this could benefit. So, you said you bought like 0.5% or something. How long ago did you buy that?
It was in the low 40s.
Okay, but there was a time frame.
About a month ago.
Oh, okay. All right.
Struggling over there.
Yeah, I'm struggling. All of a sudden, I got a frog in my throat here. All right, so let's take a look at Mosaic. Their symbol is MOS. We do see a short is only 1.7%. Institutional ownership about 81%. They have a PE ratio pretty good, 10 versus 14.9. Price to sales 1.6 versus 1.8. Price to book value very good because it's 1.9. The industry is at 32.8. We're talking about the price to tangible book value, which takes out all the intangible assets, so much stringent looking than just at the price to book value. Price to cash flow 9 versus 11.7, and a good PEG ratio of 1 versus 1.6. Now, this is what I was kind of talking about. 1 year earnings per growth change is 168% growth in the earnings. Industry up 99%. Sales are up 26.4%, above the industry at 19.5%. Here's what's disappointing, though. The 5-year growth for Mosaic is only 7. For some reason, the industry is getting a 35% 5-year growth. So I'm kind of disappointed why that is there. Would probably want to know. We do see they have a dividend yield of 1%, only use 5% of the earnings to pay that out. Look at the balance sheet. Current ratio 1.3. That is below the industry at 1.7, but that's okay. Debt to equity 0.4 versus 0.7. That is good. I do see days inventory outstanding are 97.2 versus 123. That is good. Net profit margin 16.4. That's above the industry at 11.9. And return on equity very good, 17.2 versus 10.1. Chase, what do you got?
I gotta say, I love this company. I love the idea of fertilizer. It's such a basic concept
Easy to
that you
understand.
need, and you need the farming, you need the agriculture. So I love the concept of this business. The numbers look good so far. Let's take a closer look at some other numbers too, though. Current price here, $46.87. I do see 52-week high, $47.55, and then low, $27.23. Not surprised to see this at all. Year-to-date return, well, that's up 19.3%. So great start to the year while the S&P is down 7%. So it's a company that I think is, again, benefiting from this inflation trend that we're seeing. I do see market cap, good size company here at $17 billion. If I go forward to December 2022, wow, this number looks great, $7.93. Would give us a target sell price of $131.64. I'd say don't get too excited on that number, though, because it's a little bit elevated. And what I mean by that is you go December 2023, it drops back down to $4.16. And this is one thing that does always concern me a little bit, is when you see the earnings fluctuation that's really all over the map. I see 2021 for the full year, their earnings growth is estimated to be 496%. Wow. Then again, next year, 2022 is supposed to be 57%, then a decline of 47% in 2023. So earnings are really all over the map here. It's pretty cyclical, but I still think that there's more room for this company. It's a little bit harder to value, but I still think you're okay here at the current time.
And the thing I noticed, Chase, was the range of estimates were very wide. The low was $4.70, the high is $11.12. So you got a big range there, which means no one's really certain what this is going to earn. We like those much tighter. The other thing we like to do is that I know the stock has been increasing, is that we kind of like to buy things when they're on sale, not when everybody else is kind of there. So it doesn't mean the stock won't go higher, but I don't think you're getting a great deal for the stock at the current time. Phil?
Yeah, I was just wondering if I missed the boat.
I think you missed it a little bit.
A small piece of it.
Yeah, and I got to tell you, doing this for 40 years, Phil, I look back as just like, gosh, I wish I would have done this one. I wish I would have done that one. But you just can't reality, because you're going to miss things, but you have to hopefully learn from that and go forward. But I mean, gosh, doing this for 40 years, I bet you there's probably 100 that I've missed. I look back at,
least.
But at least, yeah.
I feel like we have 3 a year at least.
Yeah. So, but it's just something that, because again, now you have all the information with inflation, food inflation is going up. Gosh, what a no-brainer! A year ago, I should have bought fertilizer companies because they would benefit. So, but that's why I love doing this, because it's not easy and it's very challenging. But when you hit it right, it's like, well, it feels good because you've done all the research. But that's the other thing, too, research. I mean, it takes us a long time to find these companies. And you can't be researching 20 different companies.
Well, and there's thousands of stocks out there. And, Phil, I know you used the analogy of the bullets in the gun before. You only have so much ammo. You can't just take unlimited shots at these companies because, well, you don't have that amount of cash.
Right, right.
It's only so limited. You can't buy everything that's out there. So you can't beat yourself up. You're going to miss things, and that's just the reality of investing.
Yeah. All right, Phil.
Hey, thanks. I really appreciate it, guys. Yeah, that's awesome.
All right, have a good one. Bye-bye. All right, that does open the phone line, 833-288-0973. That's 833-288-0973. Art in San Diego, stay patient there. We're going to talk to our financial planner, Harrison Johnson. Good morning, Harrison. How are you doing this morning?
Good morning, guys. I'm doing well. How do I sound this morning? Can you guys hear me okay?
You sounded fine to us. Yeah.
All right, good.
Yeah, good. Maybe we got that resolved there. So you're talking this morning about the time value of money. And I love this concept. Some people may not get the concept, but I'm glad you're talking about this. So explain to us, what do you mean?
So this concept, it's a little abstract, but it's really important to understand. And if you understand it, you can apply it to make decisions, because it essentially looks at opportunity cost, which all of us have a limited number of resources, so we really need to understand the total impact of the decisions that we're making. So it's really important, and if you understand it, you can use this to make decisions regarding all kinds of things: Social Security, your pension, how quickly you're paying down your mortgage, how you're contributing to your 401k, all kinds of financial things that you're doing. You need to understand not just the result, but the time value of that decision that you're making. So one way that I explain this, when I'm working with someone, I'm presenting to them, I pose a hypothetical question to them, and I say, okay, let's say I'm going to write a check to you guys for $10,000. Would you like to get that check right now, or would you like to get that check in 20 years? It's the same check, same $10,000. When would you like to get it? Well, obviously, you'd want to get it right now. And the reason is, you can use it to pay off debt, you can invest it, you can spend it, you can use that money now. But what that illustrates is that time influences the value of money. Dollars today are more valuable than dollars in the future. So, there's all kinds of things you can apply this to. So let's pull Social Security, for example. Let's say we've got somebody and they're going to retire at age 60. That's not uncommon now. I talk with a lot of people that retire in their 50s and their early 60s and everything. So let's say someone's retiring in their 60s. Well, right now, if you look at Social Security, because of the life expectancy of a lot of people now, people are living longer and longer. Collecting Social Security at age 70 usually gets you the most dollars, because people are living so long, and they're able to collect more by getting a higher payment by waiting. But the problem is, if someone retires at 60 and they don't collect Social Security until 70, that means they have 10 years of collecting nothing. So the present value of those Social Security payments, although it's larger, because you have to wait so long in order to get them, the total amount is actually reduced because of that time value. Now, to kind of go further into that, by waiting on Social Security, that means you're now depleting your other assets. Maybe you have most of your money in an IRA. You're pulling from that IRA to supplement your income. Now you're depleting your assets. Also, IRA income is taxed at a higher rate than Social Security is, so you're being taxed more heavily. Also, IRA assets would have gone to your kids, but now you're depleting that in order to wait on the Social Security, which Social Security doesn't go to your kids, so you're depleting your assets faster that way. So it's not enough just to look at the total dollar value of something. You have to incorporate the influence of time, and you use this using the present value functions, future value functions, net present value functions, understanding cash flows, and analyzing that way. And a lot of advisors don't look at things this way. I'm technically a National Social Security advisor. None of the stuff that I learned in that program talked about the time value of money as it regards to Social Security. It's all just about, how do we get the most money out of Social Security? Well, that's fine, but we want to make sure that whatever decision we're making works best for the individual person and their whole situation with the rest of their assets and the rest of their income. So it's very important to understand how the time value of money can be used to make decisions that you have to make.
And here's, I'm going to ask you, how important and how much do you use this in your financial plans for people coming in and becoming clients for financial planning?
So when I present a plan to somebody, it's not uncommon for it to take 3 to 4 hours, because the depths that I go into and the way that I explain things is a long process. And almost every decision that I make incorporates the time value of money. And so when I tell somebody that this is what they should do or shouldn't do, I go through and I have to explain these abstract concepts. But afterwards, people say, no one's ever talked to us in this way. No one's ever explained it this way, but it makes so much sense. So it's absolutely important and crucial that when people are making decisions regarding anything, that they incorporate the time value money in that.
And I was going to ask you that question. I mean, how many people come in that have a financial plan already, and you talk about the future value, the present value of money, and they say, well, my financial planner never talked about that. I think it's rare to do what you do. It's more complex, I think, because people don't get it, or no?
I mean, it's like I said, most advisors, I think, don't look at things this way. They're more concerned with selling things or managing money or whatever, where, what I do is I help people make the right decisions regarding all kinds of, their entire situation. So in order to do that correctly, we need to apply the time value money. And again, I don't know that many other people that do it, or they don't go into they don't spend the time trying to explain it, because it is a little bit abstract, but it is the right way to look at things.
All right. Well, again, people say, gosh, that sounds pretty good. I want to know more about that. We do the free consultations for people to give you a call. So I'll let you go. I'll give out how they get a hold of you. But Harrison, thank you very much, and we'll see you Monday morning.
All right. Sounds good, guys. We'll see you Monday.
Okay. Bye-bye. Again, that's our financial planner. He's a CFP, Harrison Johnson. You heard about the future value, the present value. If you want a second opinion on your financial plan, or maybe you don't have a financial plan, you do get a free consultation with Harrison. You give him a call at the office at 858-546-4306. That's 858-546-4306. You can also visit the website, smartinvesting2000.com. That's smartinvesting2000.com. You can reach them that way.
And I did want to talk a little bit about, too, while we're talking about the website is, we do our weekly stock analysis videos, and want to make sure people are aware of the one we did yesterday. We talked about Twitter, kind of a fun one. But also, too, it's interesting because we talked a lot about stock buybacks and the benefits and perhaps the pitfalls of them as well. So I want to make people aware of that video. I think it's a useful tool. We get to spend around 12, 15 minutes on one company, which is quite useful for our listeners. So you want to go to YouTube, type in the Smart Investing Show with Brent and Chase Wilsey. You'll find that video there. You can also go to our website, smartinvesting2000.com, and go to In the News, and you'll see the weekly stock analysis. So do that. Try to do that on a weekly basis.
Yeah, we have a lot of information on the website that's active, that keeps changing. So again, smartinvesting2000.com. I think you'll find quite a bit there. Phone number is 833-288-0973. That's 833-288-0973. Let's go out to San Diego and speak to Art, who's been waiting very patiently. Good morning, Art. How are you doing this morning?
Hey, good. Good morning, guys. I wanted to get your opinion on Skyworks, symbol SWKX.
Okay, and do you hold that or looking to buy that?
I bought a few shares. I get this dividend growth newsletter. About a month ago, they recommended it, and I started a position in it, but it's fallen even further since then, so I've not gotten any more, but I wanted to get your opinion on it.
Okay.
And actually, it's SWKS. Sorry, I think I gave you the wrong symbol.
No, we got it good here. Skyworks Solutions, SWKS. We do see not much short on it, 1.9%, only 76% held by institutional investors. PE ratio 16, that's pretty good because the industry is at 27. Price of sales 4.4 versus 6.1. Price of book value 14.3, well below the industry at over 100. And price of cash flow 11.9 versus 17. And you do want those valuation ratios lower than the industry average. Also, to a nice PEG ratio going forward of 1.0 versus 5.2. Earnings for the 1 year are up by 31% for Skyworks, but the industry was up 41.6. Sales for Skyworks up 28.7. They beat the industry here. Industry was only up 4.9%. And you have a 5-year estimated growth from the analysts of 12.7 for Skyworks, but 20.4% for the industry. Now, they do pay a dividend of 1.7%. They only use 25%. They're going to pay that out, so I think that's pretty good. I do also see a 5-year dividend growth rate of 14.9%, which is nice to see. Look at the balance sheet. Current ratio, very nice, 4.2 versus 3.5. A lot of liquidity there. Debt to equity, 50% versus 60%, so that is good. We do see a net profit margin of 27.2 versus 22.9. And return on equity is 26 for Skyworks, just below the industry at 26.7. Chase, what do you got going forward?
Yeah, so I was kind of looking at the company. I recognize the name, just wanted to solidify what they do, but they are in the semiconductor product market, including intellectual property in the U.S., China, South Korea, Taiwan, Europe, Middle East, Africa, and the rest of Asia Pacific. And I remember looking at this company. One big concern I believe it was this business was that Apple was a huge portion of their business. I'm not sure if that's still the case, but that would be of concern.
That's where that name is familiar from, yeah.
Yeah, and I know it was on fire for a little bit there, and it was one of the companies, Skyworks. It looks like that's fizzled a little bit as, looking at the current price at 133.13, 52-week high 204, so it's really gotten hammered over the last year. 52-week low, though, 129.72. I see year-to-date return down 14.2%. Good-sized company, though, $22 billion market cap is substantial. I do see they are a California company, though. Looks like they're based somewhere in like Costa Mesa area or Irvine. But going out to September 2023, I do see estimated earnings per share $12.88. Would give us a target sell price of $213.81. And I do believe when we looked at this company in the past, it was overvalued. So it looks like on the pullback, it trades at a pretty darn good valuation, and their earnings growth is in excess of 10% for these analysts going out over the next few years. So it looks to be a good value, good growth. I would just want to understand their customer base.
Yeah, I was going to say that exact thing. Is that I think you want to go to the private 10Q and look to see who their customers are, because they still do have, we'll say 25% of the business comes from Apple. That could be very concerning because Apple can pick somebody else. So you want to understand who they're dealing with, because it does look like a great buy. And again, when we invest in something, we're looking for reasons not to invest into it. So if you find that, they're kind of concentrated on maybe one or two customers, that's not good.
Or an Apple in particular is, Apple's got enough money where they say, we're not going to pick somebody else. We're just going to do it ourselves. And they did that to, Intel several years ago. But Intel didn't make up, that wasn't a huge part of their business. So it didn't impact them greatly. Or at Skyworks, if it's 30%, it'd be like, oh my gosh, what are we going to do? It could be quite detrimental.
and Art, if that's not the case, and that this company does have a nice diversity of different customers, I like what I see here. You got a decent dividend. You've got a good growth on the stock. So, but just check that before you jump into it. All righty?
Yeah, will do. I think you guys nailed the concern there with, I think Apple is their biggest customer. So I think that's why some people are concerned about it, even though they have great numbers. Hey, thanks, guys. I appreciate it.
Okay, Art, thanks for calling. Have a good one. Bye-bye. All righty, let's go down to Bonita and speak with Greg. Greg, you're on the Smart Investor Show, Brent Chase. How can we help you?
Hi, good morning. Well, I'm glad I got through. I didn't know with your 1 hour format that I'd have enough time. But so quickly, I wanted to know about a company. It's a chemical company, Chemours, and the ticker is CC.
Okay.
I've owned it for a while. I don't know if what happened with the inflation rate news is post or what.
And I'm glad you pronounced the title Chemours. I was wondering that when I saw that. How do you pronounce that? So thanks for doing that. So let's take a look at the Chemours symbol CC. We do see that we have, I got to pull this up here a little bit. Let's see, there we go. Then the industry of specialty chemicals, about 77% institutional ownership. We see a PE ratio of 12.9 versus 24. That's a good start. Price to sales 0.8 versus 2. Price to book value 5.4 versus 77. Price to cash flow is also good, 5.3 versus 14.2. And a PEG ratio, very good, 0.3 versus 7.1 going forward. Earnings looking good at 75% growth over the year, above the industry at 27.9. Sales up 22.9 versus 11.7. They pay a nice dividend, 3.3%. Only use 42% of their earnings to pay that out. And then look at the balance sheet. Current ratio 1.9, better than the industry at 1.8. Oh, shoot. Everything was looking so good. Now, debt to equity not looking so good here. 410% versus 0.9. So that's one thing that concerned me. I'd want to look at closer at that balance sheet. And we do see net profit margin 6.5 versus 9.4. And then return on equity is 39.5 versus 13.4.
Current price here for Chemours, $30, and I was shocked. I pulled it up. It was down 15.4% yesterday, so they must have reported earnings that were not advantageous for the company. But I do see 52-week high here, $38.87. 52-week low, $23.30. Year-to-date, down 10.6%, and wiped out all the gains that the company had year-to-date yesterday. So that's unfortunate to see. Obviously, got to dig through that conference call, dig through those earnings reports, see what's going on with this business. Also, too, this likely means you're going to probably see some changes to these estimates if the numbers were bad. But these numbers look pretty good because I go out to December 2023. Estimated earnings per share is $5.08. Gives us a target sell price of $84.33. Right. So a good value stock here. But I wonder if it is perhaps a value trap. And one thing I'll point out, too, is the chemical company. Surprise, surprise.
Yep, I know where you're going.
Oil's involved. So if energy remains high, it's going to really impact the margins for this business, and that's what could have taken it down mainly yesterday.
Yep. All right, Greg.
Earnings.
Go ahead.
Yeah, thank you. Was there earnings release actually? It's a volatile company.
Yeah.
And I thought, after the winter time, it slowed a bit. That maybe I've held it for a year and a half. That maybe it was time. But I thought we were off the races till that inflation report came out and their earnings at the dated back to back. And pardon me. And what it was is they're growing like a weed. They have different segments around the world, and their earnings were good. Their revenue was up like 27% or something. However, they missed the estimate, the analyst estimate.
Yep. And what you want to do there, Greg, too, is I think you want to kind of, maybe you did this already, but read or listen to the conference call, because perhaps it gave some guidance going forward on how energy is going to hurt their margins. So that's one thing you want to kind of listen to there. But it could be a good time because maybe down the road energy will fall, give them more profits. But we love listening to those conference calls and tie them to the numbers there. Already?
That may be it, because I didn't think they were too tied to the actual oil. It's more minerals.
Okay. Yeah, because I know we've had chemical companies in the past where 30% of their COGS or cost of goods is oil, energy. Yep. So I would want to look into that. That's definitely a key factor for this industry.
Yeah, that's one thing we say about understanding the company. That's one thing to do. Are they more dependent on minerals or on oil? What type of chemicals are they actually making here?
And if it is minerals, what minerals are those going up to? That's right. Not just oil.
All right, Greg. Thank you for calling. Bye-bye.
Thanks for your help.
All right. Bye-bye. All right. Gosh, I look over like that. We're just out of time. I did see, and we didn't get to her. I think her name was Jessica in Terrasana. I saw the notes, something about a blended family and their 50s and stuff. So
starting saving as a blended family now.
Yeah. So I'm apologize we couldn't get to you there. Give us a call next week. We're here every Saturday morning from 8 to, I almost said 8 to 10. No, 8 to 9. 8 to 9. But also, too, we have podcasts out there. You can kind of catch us on that. So, too, you can always, call the office directly if you have, important questions that you need answered. You don't have to wait till next Saturday. We are in the office to answer those questions.
Be careful with that. I'm not going to break down a stock for you.
There we go.
But if you have questions about, Jessica's question there, we're happy to help.
Yeah. All right. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you would like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 546-4306, or visit our website as well, smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information along with investment tips, go to our Facebook page, Smart Investing with Brent Chase Wilsey. Have a great day. We'll talk more next week right here on the Smart Investing Show.
To think that I did all that, and may I say